Well, I have 1 minute after. We're going to record it anyway, so if somebody jumps on a little bit later and wants to go back and grab an introduction or something, they can do that. So we'll start off this evening. Thank you, Rod, for joining us. Those that have joined in, we're going to talk tonight about basically valuation and bringing, I guess, the finances together and what makes a barn of value and what's the performance of that. Rod Leman with Growthland. We've been with Growthland for about a year and a half now, Rod, probably.
Yeah, year and a half or two. Yep.
Okay. Growthland does a lot of management, appraisal, real estate sales, specifically within agriculture. I think exclusively within agriculture as far as the rest of the team started anyway. But Rod's got a wealth of experience in a background of both production, business management, and even ownership within the pork industry. So I think I first became familiar with you, at least a lot of your colleagues, Rod, back in the swine graphics days, as that entity built and grew from a lot of small independents and almost a cooperative type structure to an extent, and then developed beyond that and sold to Cactus. So, but you've worked with other entities as well, been around a lot of different facilities, and that's Rod's work today is appraising facilities. He's also a licensed real estate agent and then a business consultant in this regard. So we'll look forward to seeing what Rod has in store and some ideas. Feel free to chime in the chat box with any questions if we get to it right away in the midst of it, or if we proceed with them later. So this time, again, I'm Colin Johnson with Iowa State University as a swine field specialist, and it's a pleasure to host these webinars once a month on topics that are important to the industry. So I'll turn it over to you, Rod, and you can share your screen at your desire, and feel free to give a little bit more background as well if you like.
Let me share the screen here. Oop. Am I sharing now? Can you see it?
Yep,
Yeah,
I see your slides.
You're
Okay.
there.
Yep. Well, thanks, Colin and Stacy, for setting this up. This is great, and I really debated about what to talk about here and how in depth to get, and I wanted to run through some numbers and some more evaluation of the investment of contract swine barns. But I think what I'd rather do is just back up a little to a higher level and talk a little bit about the state of the industry and how it's impacting contract swine barn valuation at this time. So even though we talked about swine valuation modeling, I think we're just going to kind of take a little higher level view of it and talk about some of the things that are going on right now. So surely, yeah, is that okay, Colin?
Yeah, no, Iowa's the pig finishing powerhouse. We're the mecca of it, and obviously I had a conversation today at a contract site. There's a whole lot of barns, this generational thing that's turning over as far as how old they are and how old the ownership is, and what's it take to revamp them too. Your experiences in that. So yeah, lay the foundation where we've been at, and there's a lot of different contract structures too.
That's right.
That can change these valuations, and regionally, it's very important. So
that's right. Okay. Well, just real quick, here's our swine brokerage team at Growthland. Ben and Dale and Dean and I. Dean said he might be on the call tonight, so if he ends up on the call, we might pick on him a little bit. I see he's on maybe mobile, but that's all right. This is our group here. A lot of experience. We all bring our own expertise to the table as it relates to valuing swine assets. So all these, both Ben and I are appraisers, and Dean and Dale are real estate agents here and business consultants as well. So that's our group. As far as our mission is to use our knowledge to create value for our clients through trusted relationships. And our typical client is at a transition point, a family transition, or maybe a family conflict, acquisition of additional assets, maybe wanting to grow, exiting the business, selling of assets. The interesting part of our business is we get involved in selling a lot of assets, and what we find is people they spend most of their lives acquiring assets, especially farmers, right? we spend all our life buying stuff, and then when it comes to selling stuff, we're not really all that sure how that goes and works, right? And what we should be thinking about. So we do a lot of work there. And then we do some asset management, specifically around swine asset management. So we have 4 major service areas. We do appraisals, management, which is swine management, and also land management. And then we do some brokerage and advising. So there's kind of a layout. We have 4 offices in Iowa. You can see the stars there. Last year we did about 775 appraisals. We managed 30,000 acres of row crop. We manage and advise over 200,000 pig spaces. We sold about 40 million in real estate last year, swine assets, grain elevators. And we've been doing some advising on family businesses and advisory boards. And then the yellow, so the red circles down there, those are the areas where we have current real estate, actually swine real estate deals going today. So we represent people all over the Midwest, especially on the swine asset. As you know, it's a regional business, so we tend to move outside of Iowa quite a bit. So let's just go through the swine industry condition from the producer's perspective. And this is really driving toward the discussion about contract swine barns, okay? So we're not going to talk far and wide about the industry, the condition of the swine industry. We're going to narrow it in on how it's going to start to affect and is affecting the traditional contractor in Iowa. This is Iowa State's farrow to finish profit and loss per head since 2002. You can see the awful red there and starting in 2023. Looks like we're going to continue that through the rest of the year. The point of this graph is just to show, and really the next graph is better, and I'll show that. The next graph takes this graph and adjusts the break even by $10 a pig upwards. So wherever you see making $20 profit on this graph, it's $10 profit. And Colin, I don't know if people agree and disagree with that, but I think if you talk to most of the Iowa State economists and even the guys like Steve Meyer that use the Iowa State numbers quite a bit, they'll tell you that probably doesn't represent the average producer, probably represents a little better than average producer. Does that make sense?
Yeah, and generally why that is, we're using cash values on grains with no risk management for the most part.
Yep. So I think the moral of the story is there's been, over the last 20 years, there's been a lot of red ink. And aside from 2004, 5, 6, which were a really good stretch, the big profitability events in 2010, 2014, and 2021, they were externally, I will call them externally forced supply constraints, meaning it wasn't voluntary reduction of pig numbers, right, by the industry. It wasn't the industry saying, well, this industry is not giving us a good return, we're going to cut our sow numbers. This is 2010 was the introduction of circovirus vaccine in 2009, which saved, basically the profitability event caused I'm sorry, it was 2011 with circovirus, but the profitability event was losing pigs to circovirus, okay? And then in 2014, we all remember PED was the whopper. And then the other event in 2021 was the COVID deal, which was all kinds of supply chain, aftermath of supply chain demand buildup, or supply reduction. So basically involuntary supply reduction is what's been causing the profitability events, right? Which means that we're having difficulty as an industry controlling supply for us to be profitable, which I don't think is news to anybody, right? This is the much more concerning graph. And this is the farmers and wholesalers and retailers' share of the of every dollar of the value of pork sold in the United States. And the farmers in the blue, and you can see from 1970, the farmers were getting over 50% of the value of every 50 cents on the dollar of every dollar of pork sold at the retail level. And you can see in the 90s that went down under 40, and in the 2000s it went down under 30. And now from 2016 to 2022 at least, and I think if you put 2023 will be under 20%. I think you can argue we're moving from 30 to 20. And that is a structural, that's really a structural problem with the margin structure of this business that's leading to a lot of the decisions and the strain that we're seeing in this business right now. I think this is, I've not seen, Colin, maybe you guys probably have data on corn and soybeans and like all farm products. It's probably the same thing on all farm products, isn't it?
Yeah, I'd have to look into that, but
It
pretty
feels like
similar.
it feels like it, right?
Yeah, it just depends how close we are to the end, right? I mean, if you're a grain producer and how close you are to the ethanol.
Yeah, well, that's a good point. So the producers getting less and less of the dollar, which is a troubling trend. So what have producers done to compensate? Well, they bought into packing plants. That's been kind of the fad, although lately that's been struggling as well. They've purchased land, so they've diverted money out of their swine operations and used that money to buy more stable assets, lower return but more stabilizing on your balance sheet assets. They've gone on owning as many swine assets as possible. Sow farms, feed mills, trucks, manure spreaders, finishers. You've seen them move toward, it's really, I would say, horizontal and ownership of all the pieces of swine production, right? I mean, for years, I mean, one of the reasons we have the largest contracting system in Iowa for finishers is because through the 90s and the 2000s, all the producers, they wanted to grow as quickly as possible in hog numbers, and therefore they utilized the farmers' contract finishers' balance sheet to leverage that business, and that's been great. It's been a great model up until this point, and it will be continuing. But one way to reduce cost is to own, because there's a return in every one of those things, right? If you don't own the sow farm, the producer's paying a return to the owner of the sow farm. If you don't own the feed mill, you're paying the feed mill rate of return. If you don't own the trucks, you're paying the rate of return to the trucking company, and on and on and on. And so as the margins get squeezed, the incentive to absorb those parts of the business in order to maintain the margin has been really has been front and center. Some people have gone toward value add markets, Prop 12, wean pigs, multiplication systems, Gap 1, all those things are, in some level value added marketplaces. This kind of is the thread through all this thing, but they've started to take some of their earnings out of the swine business and invest in other things. And that's really been driven by the second and third generations of some of these producers. I like to say that, we still have a lot of pig farmers that own a lot of production companies, but the pig farmers' kids are lawyers and financial analysts and CPAs, and they're looking around saying, yeah, maybe we need to try a little something different. And so that's been happening. And all these things are geared toward trying to control their own supply, obviously because controlling demand is very difficult. Really can't have no control over pork demand. So to summarize the producer perspective, the producer's receiving less of the pie than ever, and recently even so the packer. Ever improving production over fixed assets, has caused the people to hold on to assets longer to try to make them work, and keep running because the productivity keeps increasing. And that's mostly driven by, genetics, like things like that. We've had supply-driven profitability events, like we said, circovirus, PED, COVID reduction, supply chain problems. There is this ever-changing opinion about the proper real estate to maximize. You've got wean to finish systems. We've gone back. Some producers have gone back to nurseries. You've got people that think finisher sites shouldn't be more than 2,400 head. We're moving rapidly away from 7,000. At one point we were building 7,000 head finishing sites, and you don't see much of that anymore. So there's just, everybody's got their opinion. So in the Growthland opinion, the reward really has not matched the risk for the producer. And really what it amounts to is, as we start to talk about the contract barns, the producer's really not in a position, has not been in a position to feel like they can pay more for contract barns until the profitability of the industry is improved or the industry expands. Right now, we're not expanding the industry, and so not a lot of these things that I'm going to talk about coming forward are really coming to a head. But if we try to grow this business again, that's probably some of these things are going to come to a head.
Rod, to clarify, when you mentioned the rewards not match the risk, are we talking the pig ownership?
Yeah, this is all pig producer. This is all pig producer now. Yeah,
correct.
That's correct. And we're going to see how that translates to the finisher contracts. Okay. So I mean, I could pause for questions there. I guess if you can type them in I'm looking at the chat screen. You can type them in the screen. I'll try to. Maybe Stacy can help me a little bit. Try to manage that. So we'll move on to condition of swine contracting, and this is from the contractor's perspective now. Okay. So the high level trends in contracting. For the first time, I would say, in the modern hog industry, when I say talking about 1990 on, from the consolidated hog industry on, we're coming to the end of the economic life of some of the facilities, which is a place we've never been before. So these things have to work themselves out a little bit, and it's going to remain to see how that works. I would say for the first time in my career, starting 2.5 to 3 years ago, I would say probably in 2021 and on, there's been a buyer's market for space. We've been space long in Iowa for the first time in my career. I've been in the business since '91. So it's been a seller's market for space for 25 years, 28 years. And right now we're in a buyer's market for space, meaning the producer is more in control than the contractor of the market for space. Labor. They talk about real estate. We're fundamentally having a real estate conversation here. And the old axiom in real estate is location, location, location. Well, with these assets, with contracting swine assets, it's labor, labor, labor. And I don't think there's anybody that's not feeling the labor crunch here. And having a contiguous and uninterrupted labor source for contracting barns has become more and more important. I mean, anybody that's been paying attention, we're seeing strong headwinds for new construction. Construction costs up 30 to 40% over the last 2-3 years. Interest rates have doubled. Coupled with the inability of the producer to pay more, this is rather disconcerting. We're starting to see manure value or nutrient values in manure waning. We're starting to see the fertilizer market come down significantly, which is going to affect the manure values that we've been using to hold the line on swine facility values for a while. I would say existing assets with no positives will be challenged. We're going to talk about positives and negatives here in a minute, but existing assets with few positives, and don't dwell on that for a minute. We're going to get to a chart here, but we're going to see declines in values for these assets, and likely some will need to retire. But still, there are strategic buyers for assets that bring positives to them as specific buyers and to the marketplace. We'll talk about some of those things. Some of the old axioms in this business, like it's worth what you paid to build it, are being challenged. Some of that's due to the imbalance between new barn economics and the current contract payment rates. And one of the common misconceptions here is that people will say to us, well, my barn has to be worth more because it costs more to build new barns. We're starting, I would say largely that's been true, but it's been true not just because new barns have been increasing in value. It's been true because of the investment expectations that have been in place for the last 15 to 20 years. And we're going to talk about investment expectations here as it relates to barns. And what we're seeing then is tremendous variation in sale prices among different assets. And so we'll talk about this for a second. So whenever we look at a swine barn, particularly when we are looking to sell one, we're looking at these components of value. And these are broad strokes here, but really the current demand in the marketplace for barns, the location of the barns, the design of the barn, the condition of the barn, the size, the age versus new. I call that effective age. Labor and management. Are there cost of production advantages, disadvantages to the barn? What's the marketing history? Timing of the sale. Really, this is about the contract here. Is there a contract in place? So a lot of times what we'll do is we'll go through and we'll put an X, and the blue X's represent, this is just an example of how we have set up the initial evaluation of the barn would be the blue X's. So we said the current demand situation is negative. Just across the board, the demand situation is negative at this time. The location of this barn might be a neutral. The design of this barn might be a neutral. The condition of this barn might be a positive. The size might be neutral. The age versus new is positive. Labor, let's say they've got an ongoing labor situation that's positive. The cost of production is good. Maybe it's a solid sidewall barn, so the utility costs are good. It's on well water, not rural water, so the cost of production is neutral. So we go through and we put these blue boxes in, and then as we take it to the buyers, we try to find buyers that can move as many of these neutrals and negatives to positives. And if we can find these buyers, and that's kind of Growthland's job, is to find these buyers where we can take these neutral things and move them to positives, neutral and negative to positives. And that's where we can continue to see high value in barns, all right, in the sale of barns. Conversely, if you can't convert as many neutrals and negatives to positives, that's when you'll see a spread between example 1 and example 2 in the valuation. Does that make sense? Yeah. So we're starting to see a spread in the valuation of assets based on these value components. I happen to open up to any questions along the way here. Colin, how are we doing? Okay?
Yeah, I don't have anything particularly come in.
Mm-hmm. Okay. One of the things that it's important to talk about as it relates to hog barns, contract barns here, is return expectations. So I'm going to set the table here and give you an example of the return expectation on building a new hog barn. Okay. So this is just a way that we use to analyze return expectations over time. So we just look at a no risk investment like a 10-year T-bill. And so in 2019, you could lock in the 10-year T-bill for 2.1%. Today, that number is 4.5%. On a barn, if you buy or build a barn, you'd like to say you could recapture your depreciation over the life of that barn. In your investment, you want to be able to recapture your depreciation in your rate of return. So if you just take a barn and you say it has a 30-year life, then you want to try to get, you want to try to get 3.3% a year built into your return expectation in order to recapture the depreciation of the asset value over time. And then there's some kind of risk premium, okay? So you can see that just the base non-risk investment has caused the hurdle rate, the expectation about investments for hog barns to go from about 10.4% up to 12.8%. So the expectation, because I can get a better rate for my safe money, my risky money has to demand more rate of return. And that's just a fundamental of, investment analysis. So I don't want to belabor that, just other than to say that the old expectation was about 10% and the new expectation is about 13%. So if you just looked at a new construction barn in 2019, the cost to build that barn was about $300 a space, $310. You could get a $43 contract for that barn. You'd have operating costs of about $15 a space, which would leave you income per space before financing of about $28 a space. And if you use a residual value of that barn after 10 years of about 100%, which really is of what you paid for it, that's been the model we've used for many, many years. 10 years from now, they're worth about what you paid for them. Although I did say that we're starting to challenge that, but not on new barns, okay? That combination of inputs gives you an internal rate of return, a rate of return of 9.3%. So you can even see that back in 2019, we were already 1.3% shy of what I would call a base expectation, right? On a rate of return. So back in 2019, these investments by themselves weren't that great, right? Now, the guys that have been in, people that have been this a long time remember the 90s like I do, where this rate was 25%. The internal rate of return was 25%. And some people remember it being 20% and they got their labor paid for before that return. So I guess my point is, this was a dicey investment already in 2019. Make sense? Let's jump to 2023. Conservatively, we got $400 per space. The contract rate has not changed. Why hasn't the contract rate changed? Well, because there's no demand for new barns. We're not growing the industry. The producers are saying, I can't pay more than 43. We're not going to go out and pay more than 43 or $44 for new barns, because first of all, we don't need them, and second of all, we can't afford them. So you build a barn for $400 a space, you get paid 43. You probably have lower operating costs per space. You have maybe solid sidewalls on these barns now, so there's probably some utility savings. I'm sorry, operating costs went up, and the reason is because of labor. Sorry, I got backwards here. So operating costs went up. So you got reduced in income per space, which reduced your internal rate of return, right? So now we're at 6.5 versus 9.27 because our payment didn't change, our costs went up. And now we're 6.2% away from our increased target of 12.8, 13%. So it's gotten significantly worse. If you were to solve for the same rate of return of 9.3%, what would the producer have to pay today to get the contractor the same rate of return they had in 2019? And the answer is $53.50 per space, a full $10 a space more than what they've said they can't pay already. So I think, and then the irony is that still at 5350, that is still 3.5% lower than what I'm telling you the adjusted expected rate of return should be to invest in these new barns. Now, everybody's going to say, well, what about manure? And what about tax depreciation and all that? That's all great. That's all great. And that has kept the blessed aversion to tax of the Iowa farmer has kept this thing afloat for quite a while here. And it will continue to do that in certain situations. And the manure thing has been great for about the last 5 years. I don't know where that goes. Those two things have really been helping keep these values, I would sort of say, in check, or these return expectations, because they are significantly higher if you include manure value and what did I say? Tax. Oh yeah. There was a question. Do you look at the same thing with financing leverage return? Yeah, it's the same equation. I mean, you can basically multiply these numbers by whatever leverage you have. So if I'll get this wrong, I won't state the numbers, but the numbers look the same when you lever them. If you use 75% loan to value financing, let's say, the rates of return, the raw rates of return are better, because you're using leverage, but the gap to the expected rate of return is the problem that we're facing. So, Colin, this is where I was going to go into a bunch of math, and I'm not going to do it here, but I'm just going to say, in conclusion for swine contracting, the producer, the hog producer, is not getting the reward for the risk they're taking, regardless of size. And it's really hard for them to say, I'm going to pay $53 for new barns, or I'm going to raise my pay because I need space for existing farms. It's just not in the cards at the moment.
Yeah, I was just going to say, that $10 difference from $43.50 to $53.50, that $10 a space, say $5 a head, or it's probably a little more than $5 per head, actually marketed out the barn. But that's that loss that we've seen, that you showed, in consumer share of the dollar, right?
Yeah.
If we could get back to where the pig owner producer was earning that, we could afford up to that $50 maybe at that point.
Yeah, I just, I talk to a lot of pig producers, in my job, and they just, I say, where are you at on raising your rates? And they're just, until we grow the business again, until there's incentive to grow the business, which means profitability returns, we get more share, or some technology changes, like, we got this PRRS edited pig hanging out there, although, that could be a whole separate challenge. But until the reality is, we don't see this changing until the economics for the producer change. So, in the meantime, we just showed that the contractor's expectation on rate of return on investment is increasing along with their operating costs, right? I mean, everybody knows their operating costs are going up, their interest costs are going up, which means their rate of return is increasing. And I could even argue that this 12% is not where it should be, because this risk premium is going up. This risk premium, I didn't adjust it here, but you could argue the risk premium ought to be maybe 1 or 2 points higher than this, okay? Just in the environment that we're in. The issue is then the above two, it's hard for the producer to pay more, and the contractor's rate of return expectation is increasing. The above two items, they have to find an equilibrium here going forward at some point. And that's either, it has to be a combination of reduction in barn value, in values of barns, or an increase in the contract payment rates, or a combination of both. And my take is, as long as the pig producer's margin structure remains poor, it's probable that the barn values will decline more than the contract price increases, which creates again, it leads to some of these high variability in valuations based on the value components. So for example, you know, producers, barns that may be close to packing plants might have a different value component to those that aren't. And all that is because pay more doesn't just mean, pay more doesn't just mean for the contract. It means for transportation to the packing plant. It means for feed transportation. It means all kinds of things that weigh into what a particular facility is worth. Does that make sense? And so as always, and as always true in times of tumult and working toward new equilibriums, it's going to be opportunistic for some and challenging for others. So that's it at a high level. I mean, I'm sure open to conversation. I do have I have 3 more slides here and they're a little bit off. I'm going to put my Rod Leman hat on and now not my Growthland hat for those. I don't know. I debated on taking these out, Colin, but I think I'm going to go ahead with them. Okay.
Let's enjoy it.
All right. I want to preface this by saying this is Rod Leman's advice. This is not necessarily Growthland's story, but we see a lot of barns, or I see a lot of barns that are older. They're 20, 25, 30 years old. Okay. They either have low leverage or they're paid off. And this is my advice for those barn owners, for the owners today of those barns. Number one is do not refinance those barns. Do not put debt against those barns, especially to buy depreciating assets like pickups and tractors. By the way, I'm also going to say I'm not an attorney and I'm not a financial advisor, okay? Disclaimer. If you have excess cash in your operation, pay off the loans. And then use a profit over variable cost model going forward to evaluate your investment. And this is just an example. A 5,000 head finisher times $36 a space is $180,000 of revenue a year. Your operating costs, labor, utilities, insurance, taxes, maintenance, mow, snow, other, estimate $18 a space, so $90. So you've got a profit over variable cost, assuming you've got no debt or very low debt, or you've used your excess cash even from this operation to pay it down. You've got a profit over variable cost of $90,000 a year. What other part of your operation is cash flowing $90,000 a year? So then the next thing is your contract. The bird in the hand is better than 2 in the bush. That's the old saying, you right? Say yes to your producer partner. An old appraiser said this to me years ago. Don't get mad at your money. This contract is your lifeblood as it sits right now. Do the little things. The bullet points here are do the little low-cost things that keep the producer happy. It doesn't have to be big, huge items. Just if they want a little something fixed here and there, just go get it fixed. You know, don't just, you know, this is tough for some people, but try to say yes more than you say no in this particular situation now. All right. If you're asked to remodel, make sure you get a contract extension and a pay increase if you can get it. And then if you are asked to remodel, you need to evaluate the investment model, evaluate the rate of return on the remodel, and only use the remodel cost in your investment analysis. Okay. What I'm saying is, and it really goes to the last thing, when you're evaluating your return on investment on these older barns and you're going to remodel them, lower your residual value, probably 30 to 50%, no more than 100%, no more 100%. I mean, because the reason you're going doing a remodel, especially if it's a major remodel, is this barn's reaching end of life, and it's not going to be worth 100% of what you have it on. It may, I'm not going to say not, it may or may not be worth 100% of what you have it on the books today for, plus the remodel cost at the end of your contract. So these are just things to consider, okay, and think about. As far as labor goes, man, if you've got a good source of labor, keep paying them. Pay them. Give them a raise every year. Give them a bonus here and there. I mean, the labor continuity on this thing for an owner that doesn't want it, especially if somebody else is doing it, if you're hiring it done, you want those people as happy as they can be because you're retaining the incremental cash flow. You want this $90,000 to stick around, and if it has to be $80,000 because you need to pay your guy more to retain this incremental cash flow, it's every dollar you spend on that retains this 90, as much of this 90,000 as you can retain for as long as you can possibly retain it. And then the last one is sell before you reach the liability phase of this investment. And when does it become so then this is selling a barn, my advice, okay? When to sell a barn? Before it becomes a liability, before the contract is up. We're seeing barns in Iowa that have been sit empty for 2 years without a contract. It's very difficult to sell a barn that has a history of sitting empty. If you're going to lose, or you can see an end coming to your labor source, you're starting to get to the liability phase on your barn, or if you have no next generation. I mean, that's pretty straightforward, and most people know that, but it's good to hear sometimes. And then I would say, when else does it become a liability? You need to sell it before. If you're not up for doing the major remodel to get an extension of your contract, you need to sell it while you still have a contract and before doing any kind of major remodel, because the new owner is probably going to want, if they want to assume your contract, then maybe they can do the remodel that your producer wants, but they may want to switch producers, and that producer may want an entirely different specification. And then these are really important things to remember or do as a seller. I did a little Growthland minute about some of these here, but again, this has to do with us doing a lot of buying as farmers and not a lot of selling. But things to remember: get your documents in order. Look at your contract, understand the assignability of your contract, understand if you can terminate your contract. You need, obviously, in any real estate transaction, you need to get your abstracts in order. Manure agreements, this is a huge one. We see all kinds of manure agreements with language that's not very good and not well documented, and it's unclear about who gets the manure, who pays for application, if there's any nutrient management or nutrient payments being made based on the nutrient analysis. You really need to sew those up and have them all ready to go if you're thinking about selling. And then make sure you understand your easements on land, if you've got easements. And what we find is a lot of family farms never have had to had easements, okay? So because they've been spreading manure on their own ground. So you need to be prepared to offer easements to buyers, or binding manure agreements that take, that are the same thing effectively. And you need to be willing to have those recorded by the recorder, county recorder. One thing we see quite a bit of on family operations is we see barns that sit on ground that's not been surveyed off of like a wider parcel, like a acreage or a wider parcel of cropland. That's going to be important to have done if you're getting ready to sell a barn. And it's great to have some operating expense history. The buyer's going to want to know what's the LP cost been running? What's the, obviously taxes we can look up, but what's the maintenance been running? What's the insurance cost? Those sort of things. So those are all important things to get ready when you're thinking about selling. And then when you're selling a barn, you want to strike the best manure deal you can with a new owner. If a lot of the owners newer owners are absentee investor types, and they're looking for people to take the manure. And now's your time. At that point of inflection where you're selling that barn is the time to negotiate with the potential new owner of that barn, an advantageous manure agreement for you. And things to remember, you've received accumulated financial benefits from this barn. This investment has worked for you, and it has to work for the new buyer. And you may need to adjust your price expectation accordingly. I mean, we've been through the return expectations having increased because of interest rates and all these things in new construction and all these things we've talked about. These things need to work for new buyers or they won't get sold. And then particularly an unsold empty barn in an estate or trust is, in my opinion, is the worst kind of headache or liability for an absentee owner with absolutely zero farming interest. And I'm talking about your next generation now, your kids, your grandkids. Because then it becomes, it can become a burden to them. So I guess the moral of the story is you need to, in my opinion, it's worth thinking about these things ahead of time before they pass to a second generation that has no idea what to do with them or how to even go about converting that asset to cash. And then you can consider seller financing to neighbors, to the existing labor source, other barn owners in the area. That's a way to slowly exit out of the business. So I hope none of that was too stark and out of line, Colin.
No, I think we can appreciate your candidness on all of those, right? I mean, especially preparing for the next generation or not preparing for them and realizing that, yeah, all these, they have a life expectancy. So,
yeah.
I'm
not trying to be negative at all. Really, believe me, I'm in the business of selling hog barns, and I love them, and I love to help people do that and navigate these things. And our team is an expert at that. There's just a lot of things to think about, and people don't spend a lot of time thinking about it up front.
Yeah, that's right. Any idea, Rod, on what's a decommission cost? Especially on a permitted size building, there's regulations on this about burying it and turning it down, but turning it back into 15,000 an acre farmland or more.
Yeah, I don't have those numbers right with me, and off the top of my head. I can tell you what we're seeing some of. We're seeing some of concrete and slats that are really in pretty good shape, and taking the tops off these barns and building right over the top.
Yeah.
If you want to be in the hog business and you own a hog site, I mean, that's a viable, if you can secure a contract, that's a viable option, even in the construction cost environment that we're in. You have to kind of consider, again, from a investment analysis standpoint, rate of return analysis, you kind of have to consider that, the concrete and the slats sort of a sunk cost, if you will, and analyze the investment on the new cost of construct, the new build. But if you need manure and you can utilize bonus depreciation and things like that, I mean, there's still a place for taking these things down to the concrete and starting over.
Mm-hmm. And it fits in your labor, right? I mean, I appreciate all your comments on labor. That's a number one goal. And I'm assuming, when you say Growthland does such a your real bread and butter is finding the matches, and that's going to vary county by county or regionally. And I'm sure that labor piece, and also which pig ownership is in the region, but that labor thing's got to be number one, especially when you're nowadays selling the barn site and not the whole 80.
Yeah.
I see Chet had a question there.
Yeah, it says, this is great. From a pig owner perspective, I can say there's a $5 to $25 per space swing in pig value difference just in the quality of chore. Yeah, labor. Yeah. I mean, and here's the thing, I didn't really say this today, but I really think to grow this business again, the producers are going to have to get much more active in providing labor because, for a while, well, I'll say this, from the mid to early 90s all the way up till I would say the year 2000, this contractor, this farmer provides the labor, farmer provides the, takes the manure, farmer does the, farmer does the labor as part of a diversified farming operation as far as a contractor's farming operation goes. That was kind of the model. And then we went on this little triple net lease thing in the early 2000s where some of the investors say, well, I want in on these, but the producer has to labor them for me because I don't have labor. So there was a lot of triple net lease stuff happening. And then with producer provided labor or contracted labor. And then I would say probably maybe 10 years ago, some of that started to dry up. And then we went back, we kind of continued to rely more on the contractor model, but everybody has the same problem, which is labor. And so I see the traditional contract grower model sort of fading away a little bit, just because there are fewer and fewer young people that want to go into these barns and put the sweat equity in them that their parents did, right? Especially new barns at what they cost. So I think we're seeing slowly that market, that pool of operators sort of decline as a buyer pool or as a contractor pool. And we're moving toward, more investor type people, more tax averse oriented people that are going to require a labor source. And that's one thing I didn't say here, but I think we're going to see producers having to step up with labor solutions more and more if we want to significantly grow this industry again and have new finishing space and turn over existing finisher space to new owners. I'll end with how can Growthland help? I mean, number one, we understand how to market swine assets in the changing landscape. We drive the highest value by understanding the target buyer, where we're turning those value components from negative to positive. We're understanding how to price assets based on value of the components. We pride ourselves in bringing more than one buyer. I mean, here's the thing we encounter a lot, Colin. We work with a larger sow operation. I'll just give you an example to sell a sow farm, and they said, well, we don't want if this buyer, and this buyer, and this buyer, and this buyer, and this buyer come to the table. They had like 6 people they wanted to call first to see if they could sell it on their own. Okay, because the industry is pretty small, and generally people think they know who to call, and a lot of people do, and some people don't, but lots of people do think they know who to call. They say, well, I'll just call, Tyson, or I'll call Cactus, or I'll call JBS, or whatever. And the reality is, this sow operation that we're working on selling, all 6 of the buyers that they just wanted to kind of protect from our, I would say, commission structure on that sale. Not a single of those buyers, we had 2 offers from 2 different buyers, and not a single one of those 6 that they wanted to protect came to the table as a prospect. Okay.
Mhm.
So, I think that's one of the values we bring is just the depth of our contact list and making those matches. And then the other thing we do is people say, well, why, how do you, real estate transactions, you're just a realtor, you don't do anything. Well, this is not a typical real estate transaction. This involves lots of times involving negotiating, even renegotiating or negotiating new grower contracts, which we get in the middle of a lot of times. It involves remodel specification and cost, which we get in the middle of a lot. Cleaning up manure agreements, man, we see a ton of that needing to be done during these transactions. We've had to negotiate subleases where one producer doesn't want to leave and the new owner takes over, but the old contractor doesn't want to exit for one turn, but they don't want to sign a new contract with the new owner, so we end up having to negotiate a sublease until as a bridge to a new contract. Septic inspections, appraisals, easements, abstracts, loan releases. I've only been doing swine real estate transactions for 2 years, and I was shocked how complicated and how many things we get involved with to move one of these things from an initial acceptance of an offer to a close. It is definitely not like selling a house. So, and then we pride ourselves in working with your other trusted advisors. We'd like to be trusted advisors in the decision around family farm businesses. Sometimes we help sellers realize there's life beyond the swine business, and that can be tough. But we can help people kind of transition on through that. And then we enjoy it working with strategic buyers. If you're wanting to grow your business and you're looking for opportunities, we work with buyers and do due diligence for buyers, represent buyers as well as sellers. And so we have a very good feel for what's out there for opportunities a lot of times. And a lot of buyers come to us and say, here's what I'm looking for. And we get set about trying to make it happen. So that's all I have. There's our team. I'll finish with our team again. And I had another question. Do you have an estimate needed premium to justify a remodel for the Prop 12? Oh, wow. I don't know if I want to go on record, Mark. I tell you what, I don't have any direct knowledge. Okay, Mark, so I'm not going to say. I hear numbers flying around, but I just think it's probably best that I don't say anything, because somebody will say, well, Rod said it was this or Rod said it was that, and I don't have any direct contractual knowledge that I'm either could say or should say. How about that?
Well, I think we can both respect that there's a lot of variable around it, right? Are we just remodeling space as far as floor space panning, or how deep do we go? Ventilation changes that are required as well with it. Feed and logistics of all of that too is a part of it too. So
I think the one thing we can say is we're seeing the industry pause on more Prop 12 a little bit. I think there's just still a lot of uncertainty from the packers' perspective about what meat's going to flow into California. Are we going to be able to sell the whole pig into California? If we can't sell the whole pig into California, then that means the cost of the pig, the parts of the pig that we can't sell into California, need to be borne by just the meat that's going into California, right? Because if you can't sell a butt into California, and that butt costs you 20 cents more to produce because it's Prop 12, you got to add that 20 cents from the butt pounds into the meat you're selling into California, because nobody's going to pay 20 cents more for it outside of California, right?
Mm-hmm.
So I think there's just uncertainty around that, how much processed meat is going to be, because processing is exempt. I think what we're hearing from packers at the moment is that they've got the supply they need momentarily till they really figure out what this thing is gonna look like. And so I'm sure there's sporadic projects here and there, but generally speaking, it's hit a bit of a pause. That's probably about all I know.
Mm-hmm. All right. Well, I have just a minute after 7, straight up hour, and that's what we had kind of asked of you, Rod. I appreciate that input. Your contact's available. I appreciate the Growthland team as well, you know, and blessing kind of what you shared today too. So your experience has been valuable. There's a lot of things there, you know, the day we're in of cost and value of money, and then the fact that we're long on space kind of foretells a lot of what you've done there. So, but if anybody wants to reach back out to Rod, they're welcome to. So appreciate on behalf of the industry, on behalf of the Iowa Pork Industry Center, taking your time, Rod.
Well, the last thing I'll say is I don't know how it's all going to work out. You know, if I knew that, I'd be off on a beach somewhere relaxing. But
well,
it's going to be interesting, and look, good producers and good business people and sound thinkers and hard workers are going to make it through this, just like we have, you know, forever. So we're you know, we don't want to be negative on this industry for sure. We're still trying to push forward, just like farmers do. So.
Yeah, there's honestly no better place to raise pork. It's just finding the worldwide economic system and the sustainability issues right here in Iowa to get it done with the right partners.
That's right. Well, I appreciate the time today, and yeah, feel free, anybody, to reach out. My phone number's there, email, whatever you need.
Thank you.
Thanks.
Thanks, Rod.